All right, welcome to our video here on the income statement. Now, this is our first video. We're going to kind of go over this, so it's really kind of the basics. But the income statement, what are some key things about it? Well, number one, it's an annual review. It represents a period of a year, so it could be, well, a period of time. It could be a year, it could be monthly. And really, the income statement has a few focuses, and the number one of those is that it's trying to identify what income and expense relates to the business. Well, there's a couple of ways that the income statement works, and one of those is that we're going to be looking at it on what's called a cash basis or an accrual basis. Now, we talked about these before. Cash basis is when you record income and expenses when they happen, when cash moves, Accrual is recording income and expenses when they happen, which means that you're going to end up dealing with something called inventory. So inventory is this concept where we're trying to compare. So ending inventory is a number, and then beginning inventory is another number for whatever period of time that we represent here. And so in the case of sales, and so I'm looking here at sales. In the case of sales, ending inventory being $1,000 and ending inventory being $1,000 and beginning inventory being $1,000 means there was no change. So whatever you called sales is probably exactly right. There's no change. However, if you have a situation where ending inventory is, let's say, $1,000, so that means we ended the year with $1,000. However, when we began the year, we began with $2,000. Then that lets you know that over time, $1,000 has gone away, and we need to take that out of sales because sales already has the entry. We've already got $1,000 in sales. The fact that it came from inventory means it really shouldn't have been given us credit that year. So it's called a deduction or a change in this case. And the change is negative because of these brackets that you see here. So to draw another example out, maybe let's do a third one over here. If you have a situation where ending inventory for the year is, let's say, 10,000, and beginning inventory for the year was only 2,000, then therefore you have an $8,000 change, and that $8,000 change is not negative but positive. So 10 minus 2 would be a positive 8. This would tell us that we must have began the year with very little, right? Just a little bit here. But we ended the year with quite a bit more. So our business looks like it's grown. However, if you just looked at regular old sales, so regular calf sales or grain sales, you would see a number, but that number wouldn't quite represent everything. This $8,000 change is what we need to add to that. So when it comes to an income statement, accrual adjustments sometimes play a role, and they play a role through the income category, as I have talked about here. So to summarize, inventory change in sales decreasing translates into more sales. So if you have inventory change and the sales are decreasing, this translates to more sales, but they came from inventory. What about another? Inventory is increasing. That translates to production is up, but just not sold yet, which is kind of the example that I gave right here. So there's two types of inventory. One is where inventory is decreasing, which is here. And that means that sales need to be taken off because those don't count for this year. It was actually produced last year. Or you have situations where inventory is increasing. That means that sales have not happened, but the production did, so we need to give ourselves credit for that. That's like the 8,000. All right, now, what about expenses? Well, it's the same concept. Of course, I guess it's the same, it's the opposite. But we need to apply accrual adjustments because sometimes we have expenses, but we really haven't spent that money yet. So for example, let's just say we had feed inventory. Now I'm going to switch these. If you notice, they've actually changed places on before. Before it was ending minus beginning. To keep our positives where they make sense, it's really now beginning minus ending. So for example, we began the year with $2,500 in feed inventory. We end the year with only $1,000. That means that we fed out $1,500 more than we actually had to buy. We pulled it from inventory. So if you look at expenses by themselves are not right. If we add additional expenses, change in inventory to our expenses, that then gives us the correct amount of expenses. So to summarize again, accrual adjustments beginning minus ending for expenses or ending minus beginning for income, these two things are important so that we can get a good annual review or annual value of net income, which is kind of the original focus. So before